When we discuss strong retail stocks, the ones often closely linked to economic recovery, HMPRO or HMPRO, it always ranks high.
Yeah, it's definitely one of those reliable names, a kind of bellwether for consumer confidence.
Exactly. But right now, we're operating in a pretty tough environment. Consumer purchasing power is weak, and the property market still sluggish. So the big question is, what strategy is HMPRO actually using to drive its crucial SSSG, that's same-store sales growth?
And are there any bright spots, any positive signals buried in those Q3 2568 earnings that just came out?
That's what we're here for. Today, we are diving deep into HMPRO. We'll be evaluating its fundamental factors based on all the latest available data, specifically focusing on those Q3 results. Our mission really is to give you, the listener, a shortcut to being well-informed. We'll cover everything from the raw earnings numbers to their bold new hybrid store strategies and the longer-term investment picture.
And that complete picture, right now, it's defined by, well, quite a bit of complexity. And contradiction, even.
Sure.
Well, you've got this management team, right? They're known for being incredibly efficient, great operations, tight cost control, really good at what they do internally.
Okay.
But they're battling these persistent, relentless macro headwinds, things totally outside their control.
Right, the broader economy.
Exactly. So as our sources show, the HMPRO story in Q3 is basically one of strong internal discipline, proactive strategic moves, fighting desperately against a very weak external environment.
So strength versus weakness, we need to figure out where they're actually winning and where the market is just, holding them back.
Precisely. We need to dissect that.
Okay, let's unpack those Q3 numbers then. And unfortunately, the raw financial snapshot, it really confirms the difficulty they faced. The headline profit number, certainly disappointing.
It was, yeah. A clear contraction, and it kind of confirms the market's caution. For Q3 2568, HMPRO reported a net profit of 1,303.57 million Thai baht.
Okay.
Now you compare that to the same period last year, 1,442.00 million baht. That's a year-on-year drop of 9.60%.
Wow, nearly 10%. That's pretty steep for a company like HMPRO, known for its consistency, right?
It is. And that profit decline, it ties directly into the overall dip in activity. No surprise there.
Makes sense.
Total revenue for the quarter, down 1.74% year over year, landing at 16,715.77 million baht.
Okay.
And if you look specifically at the core business, sales and service revenue that was down slightly more, 1.93%.
So definitely a downward trend. It's clear confirmation that shoppers are kind of hitting the brakes, delaying those bigger purchases maybe. New appliances, renovations, big furniture items.
That's exactly it. People are holding back.
So why now, specifically in Q3? Looking at the core causes in the source material, it feels like HMPRO got hit by like a double whammy, economic reality and some specific operational issues.
That's a good way to put it, a double whammy. The persistent decline is really down to two main forces. First, as you said, the continuous slowdown in consumer purchasing power. That reflects the overall sluggish economy.
Inflation, debt, people just have less disposable income or maybe less confidence to spend it.
Right. So fewer people are willing or maybe even able to finance those big home improvement projects. That's the underlying persistent pain point.
Okay, that's the macro picture. What was the second force? The more specific one.
The second factor, and this one really hammered their physical branches in Q3, was the weather, the specific seasonal impact.
Ah, right. The reports mentioned heavy rain.
Yeah, and not just a bit of rain. It apparently started earlier, back in Q2, and then continued really heavy right into Q3. Caused severe widespread flooding in several key regions.
That's interesting, a very specific operational challenge. How does heavy rain and flooding directly translate into, say, that 1.93% drop in core revenue? Seems quite direct.
Well, just think about the shopping experience for a minute. HMPRO runs these big warehouse-style stores, right? If your neighborhood is flooding, or even if just getting around town is a nightmare because of the rain, trekking out to a huge home improvement warehouse for, I don't know, a new shower curtain or some tiles, it's probably the last thing on your mind.
Yeah, fair point. Convenience goes out the window.
Exactly. The inconvenience factor becomes massive. It directly cuts down customer traffic, and less traffic means fewer chances for those impulse buys or even the planned purchases people might have put off.
Okay, so the top line is shrinking. That inevitably puts pressure on efficiency metrics. Let's talk margins, specifically the gross profit margin or GPM. Did they manage to hold the line there amidst all this?
We did see some pressure, yeah, but honestly, it was pretty slight, which, given the revenue situation, actually speaks volumes about their operational discipline.
Okay, so what were the numbers?
The GPM decreased, but only modestly, from 27.05% in the same quarter last year down to 26.78% in Q3 2568.
Okay, so a slight dip. But even a small fraction hurts when the overall sales volume is already shrinking, doesn't it? What specifically squeezed that margin? Was it just like heavy discounting to drive sales?
Actually, it was two different things, both kind of consequences of the weak sales environment. First, it relates to their buying power.
Okay.
The company got smaller trade discounts from its suppliers. Why? Because their overall order volumes were lower. Simple as that. You buy less, you lose some of that bulk discount leverage. That hits your margin directly.
Makes sense. Less volume in, less discount. What was the second factor?
The second one was actually an increase in costs related to providing customer services.
Wait, an increase? That seems counterintuitive when sales are down. Costs went up for services.
Yeah, it's a fascinating little anomaly, isn't it?
It is. So margins are squeezed overall, but service costs rose. Does that mean the service side of the business, like their HMPRO platform, is actually doing okay? Maybe even thriving while retail sales are weak?
Bingo! That's exactly it. And honestly, this is probably the single clearest positive signal we can pull from the Q3 numbers amidst all the gloom.
Really?
Yeah. The revenue they generated from customer services, specifically that HMPRO platform, it still managed to show growth compared to the same period last year.
Interesting. So people might be delaying buying a new kitchen, but they're still getting the leaky faucet fixed or the air conditioner installed.
Precisely. It suggests customers are prioritizing necessary maintenance, installation, repairs, even if they're putting off the big discretionary spends. This service ecosystem provides this really crucial layer of stability. It's resilient.
How so?
Well, it generates revenue, keeps their technicians busy, and crucially, it reinforces customer loyalty even when times are lean. It keeps the HMPR brand relevant day to day.
Okay, that service growth, that layer of stability, it must be welcome. Because it brings us neatly to what's probably the most painful metric for any retailer right now. Same-store sales growth, SSSG. Even with that strength in services, HMPRO's core physical retail side is clearly struggling.
Oh, the SSSG struggle is definitely pronounced. And the real worry is that it seems persistent. Analysts are expecting SSSG to stay weak, probably continue to be negative, actually, even as we move into Q4.
And Q4 is supposed to be the high season, right?
Exactly. It's the peak season for home improvement. But weak purchasing power is it's the main culprit everyone's pointing to. And look, this isn't just an HMPRO problem. This weakness has been seen across the whole retail sector all year long. It's putting massive pressure on everyone's profit estimates.
So when SSSG is negative like this, management is under intense pressure, isn't it? You can't rely on your existing stores to grow the business. You either have to slash costs, boost margins somehow, or find completely new revenue streams.
That's the challenge. They have to get creative.
Okay, so given that physical store sales are lagging, HMPRO isn't just sitting on its hands. They're pushing hard on this omni-channel strategy. What are the key parts of that counterattack? It seems like a mix of digital investment and rethinking their physical stores.
It is. It's kind of a classic strategy. Invest for the future while you fight the battles of the present. On the digital side, there's a clear, ongoing push to increase the proportion of online sales.
Do we know what percentage that is now?
Well, we know that back in Q1 of 2564, online sales were already 5.9% of their total sales. Management's goal is definitely to see that number climb much higher.
And why is that so important, just capturing online shoppers?
It's partly that, yes, capturing the market shift, but it's also about efficiency. When online sales are executed well, they can carry higher margins because you have lower operational overhead per transaction compared to a big physical store.
Right, less rent per sale, fewer staff maybe.
Potentially, yes.
Yeah.
And to support that bigger online focus, they're making some pretty significant infrastructure investments. It shows they're serious about logistics efficiency. Specifically, this automated storage and retrieval system, the ASRS.
Okay, tell us about that. ASRS sounds high-tech.
It is. They're investing heavily in a new distribution center that features this ASRS technology. Basically, think robotics and specialized hardware. It automatically stores inventory, retrieves it, manages it, all with incredible density and speed.
So fewer people running around a massive warehouse looking for things.
Exactly. It drastically cuts down on labor costs, retrieval errors. It's all about speed and accuracy. And this is explicitly designed to support their long-term growth plans, especially the expansion of e-commerce. Faster fulfillment, lower logistics costs down the line. That's the goal.
But hang on, the sources mention a pretty long payback period for this ASRS, didn't they? Something like 5 to 10 years.
They did, yeah.
Is making that kind of long-term capital commitment really the right move right now, given the immediate pressure to boost SSSG and maybe conserve cash?
That's an excellent question. It really gets to the heart of their long-term strategy versus short-term needs. Yes, the payback is long, but you have to see this as strategic capital expenditure, or CapEx. It's an investment in the fundamental plumbing of the business. It's designed to reduce their cost to serve permanently. They're essentially trading some potential short-term spending, maybe on promotions, for long-term operational resilience.
So the bet is that efficiency pays off later.
Right. If they can fulfill digital orders faster and cheaper than their competitors 5 or 10 years from now, that efficiency translates directly into a sustained margin advantage. And for a high-volume retailer like HMPRO, that's absolutely crucial.
Okay, so building the foundation for the next decade while weathering the current storm. Let's switch gears then to their physical store strategy. Because they're not abandoning bricks and mortar, they're reinventing it with this hybrid store model. That sounds interesting. It seems designed specifically to hedge against relying purely on consumer spending.
It does. The HMPRO X Mega Home hybrid store concept. This is being positioned as their blueprint for future expansion, especially in those economically important areas like the Rayong EEC corridor. It's a very clever dual-target strategy, all under one roof.
Let's use the Foot-a-Month Sai 4 branch as an example. The sources gave some details on that one. What makes this hybrid blend so compelling? Why merge HMPRO and Mega Home?
Okay, that branch is a big commitment. We're talking an investment of over $570 million by it, covering more than 13,000 square meters.
Yeah.
Huge space.
Wow.
The key difference is synergy comes from the customer mix. The traditional HMPRO side caters to your regular B2C end users, right? The lifestyle customers looking for furniture, appliances, decor, often higher margin stuff.
Right.
But the Mega Home side, that's dedicated to B2B customers. Think technicians, contractors, small builders, even industrial factories. It focuses on wholesale, bulk construction materials, tools.
Okay, so serving both homeowners and builders.
Exactly. And the competitive advantage is the potential for cross-selling. Imagine a contractor comes in to buy bulk cement and steel from the Mega Home side. While they're there, maybe they get upsold on installation services or some professional-grade power tools or even high-margin interior finishes like lighting or tiles from the HMPRO side for the project they're working on.
Ah, I see. So you capture more of their total spend on that project.
Precisely. It significantly increases the total wallet share you can capture per customer visit. And their goal for a single hybrid store like this, it's ambitious. They're targeting monthly sales of at least 60 million baht. That shows you the scale of revenue they expect from mixing these customer bases.
That B2B element certainly adds a layer of potential stability, maybe less volatile than pure consumer discretionary spending. Smart. But they're not only building new hybrids, are they? They're also investing in upgrading existing stores.
Correct. They're carrying out very targeted renovation efforts aimed at capturing specific, localized regional demand. Take the Krabi branch, for example.
Okay.
That one received about 113 million baht in upgrades. Now, why Krabi? It's a major tourism and business hub. So the renovation was specifically designed to attract business from hotels, resorts, other businesses needing large-scale, professional-grade fit-outs. It's about moving beyond just serving the local homeowners.
Tapping into that commercial demand. Makes sense for a tourist area. What about the renovations in more urban areas?
Yeah, look at the Rama 3 branch, closer to the dense city center. That got a 40 million baht renovation.
A little more budget there.
Smaller budget, different target. This upgrade specifically aims at urbanites, working professionals, maybe elderly residents living in high-density condos or apartments.
Okay.
So the emphasis there is on one-stop shopping and total home solution. Things tailored for smaller spaces, quicker fixes, stuff that appeals to time-poor city dwellers. It's a clear recognition that different locations need different approaches, different inventory, different service models. So looking ahead, despite all these short-term worries about SSSG and the economy, HMPRO's management isn't actually hitting the brakes on expansion overall. That shows some long-term confidence, particularly in their domestic market strategy.
Okay, so what are the actual domestic expansion targets? What have they laid out for, say, the current period, 2,568?
The plan is pretty robust, actually. They intend to open a total of 12 new branches in 2,568.
12 new stores in this climate.
Yep. It's split between 7 new HMPRO stores and 5 new Mega Home stores. Likely, many of the HMPRO ones will incorporate mega home elements too, following that hybrid logic.
And that takes significant investment, obviously.
Huge. This level of new store openings requires a substantial investment budget, somewhere between 7 and 8 billion Thai baht. And that capital is being heavily directed towards areas they've identified as having strong economic and industrial potential.
Like where?
Think the strategic Rayong EEC region, for example. Lots of industrial activity there, which guarantees a baseline level of that B2B demand we were just talking about from Megahome.
Okay, so clear confidence in the domestic B2B and hybrid model. But if we're talking market expansion, we have to address the big international news, the Vietnam withdrawal. That was a pretty significant strategic retreat, wasn't it?
It absolutely was. And honestly, it serves as a kind of textbook cautionary tale. It highlights the potential pitfalls of jumping into high-growth foreign markets if the operational or logistical fit isn't quite right.
So what happened exactly?
HMPRO formally decided to close its subsidiary over there, which was called Home Product Center Vietnam Company Limited. The official reason they gave was that the branch expansion model they were trying to implement was, and I quote, not suitable for current investment.
Not suitable. That sounds diplomatic. They'd been working on this Vietnam venture for a few years, right? Since late 2563, I think?
That's right. They put time and resources into it.
So what was the financial hit from pulling the plug?
The direct financial consequence reported was an impairment loss of 21 million baht.
Okay, 21 million. On HMPRO's scale, that's not catastrophic, is it?
No, not financially crippling by any means. But it's significant because it represents an acknowledged failure of that market entry strategy. It's the cost of the resources they spent trying to make it work, now written off.
Right. Now, the analyst speculation on the deeper reasons for the exit, that's where it gets really interesting, I think. What were the underlying factors that might have stopped HMPRO from getting traction in Vietnam?
Analysts pointed to three main possibilities, and they really drill down into execution and strategic fit. First, the potential returns on investment, the IRR, or internal rate of return. It seems clear it just wasn't measuring up to HMPRO's demanding internal targets.
Meaning they could get better, more reliable returns by investing that same money back home.
Precisely. If building more hybrid stores in Thailand offered a clearer path to profit, then pulling out of a struggling Vietnam venture becomes the prudent, rational choice from a capital allocation perspective.
Okay, IRR was one factor. What else?
Second, there was potentially a cultural and product suitability issue. HMPRO specializes in Thai and international styles of home decor, appliances, fittings. Their standard product mix might simply not have resonated strongly enough with local Vietnamese tastes or needs. Making the necessary localization changes could have been a slow, expensive, and uncertain process.
So maybe not the right products for the market. And the third factor, you mentioned execution and logistics earlier.
And that's often the killer in international retail, isn't it? High logistics and transport costs. Vietnam has, by all accounts, a very fragmented and complex distribution network.
Okay.
Analysts suggest that the high costs of simply getting products from Thailand or other suppliers into the Vietnamese network, combined with high domestic transport costs within Vietnam, made it incredible. I think that's spot on. This exit frames their approach perfectly. They are fundamentally cautious, maybe even conservative, when it comes to unproven ventures. If a new market doesn't show a clear, credible path to generating the kind of returns HMPRO demands, and within a reasonable time frame, they'll cut their losses relatively quickly. They'll redeploy that capital where they have proven market knowledge and dominance, which right now is Thailand.
And that decision, that exit, should probably serve as a bit of a warning signal for investors looking at the broader Vietnamese retail scene, right?
Yeah.
Just because GDP growth looks good on paper doesn't automatically mean easy success for foreign companies jumping in.
Absolutely. It's a reminder that execution, local fit, and logistics are critical. It's not always a gold rush.
Okay, so summing up so far. We've got weak Q3 earnings, operational challenges from things like the weather, but also this highly disciplined domestic expansion plan, strong strategic moves with the hybrid stores. It's a real mix. Given these conflicting signals, how is the market, how are the analysts actually reading HMPRO right now?
Well, as you might expect with such a mixed picture, the analyst consensus is also highly mixed. It really reflects that tension we talked about, the company's internal quality versus the tough external economic reality.
So no clear agreement.
Not really. Recommendations are scattered all over the place.
Yeah.
You've got some firms like Krungsri and PI still maintaining a buy recommendation, but then you have others like KGI and ASPS rating it as neutral. And crucially, this includes several firms that have actively reduced their price targets recently.
Okay, so that scatter really illustrates significant caution about the immediate growth prospects.
Definitely. The market is hesitant.
But let's talk about those who are still positive, the ones keeping the buy ratings. They must be focusing on those strong foundational metrics we touched on earlier. What are their core arguments for staying optimistic on HMPRO, despite the profit contraction?
Yeah, their confidence seems rooted in HMPRO's underlying financial resilience and that high quality of management we discussed. The key points they tend to highlight are: 1. A strong underlying business base, despite the current dip. 2. Highly efficient management that has proven it could protect margins even during downturns. 3. Strong ongoing cash flow generation. 4. What they see as an attractive current valuation, especially after the recent share price weakness. And 5, critically, that very low debt-to-equity ratio, the DE ratio.
Right, let's talk about that DE ratio again. Nomura cited it earlier at, what was it, an impressively low 0.7 times. What does that number really tell us about HMPRO's resilience compared to maybe other retailers?
Yeah, a DE of 0.7x is phenomenal for a retailer, especially one that's quite capital intensive with all these big stores. It essentially means for every 1 unit of shareholder equity they have on their books, they only have 0.7 units of debt.
And how does that compare?
It's way below what you often see in the sector. Less stable or more highly leveraged retailers might have ratios climbing well above 1.5x, sometimes even over 2.0x.
Wow, so what's the benefit of having such low debt?
Flexibility and safety. This low debt burden means HMPRO has massive headroom. They could borrow aggressively for future expansion when the economy eventually turns around. Or perhaps more importantly right now in the short term, it heavily insulates them from the impact of rising interest rates. Their interest payments are much lower than highly leveraged peers. This financial flexibility is really the bedrock of that quality company argument.
Okay, a strong foundation. However, even that financial strength hasn't stopped analysts from adjusting their outlooks downward. The general trend seems to be price target reductions, correct?
That is the prevailing reality, yes. Because of those persistent concerns over same-store sales growth, SSSG, there has been a definite trend of target price cuts across the board. We're seeing recent targets falling more towards the, say, 7.50 to 9.80 Thai baht range.
Down from previous highs?
Yeah, down from more optimistic levels seen earlier. The market is clearly pricing in a delayed economic recovery and its impact on HMPRO's near-term growth.
Okay, let's shift focus then to the immediate future. What are analysts expecting for Q4 2568? This is traditionally the highest season for home improvement activity, right? Decorating for the holidays, end-of-year bonuses, maybe?
That's right. Q4 is usually the peak. And analysts do anticipate a sequential rebound. That means they expect Q4 results to be better than Q3.
Okay, better than Q3. Why?
Primarily due to those seasonal factors you mentioned, Q4 being the high season. People tend to do more home projects then. Plus, there's a possibility of slightly lower interest expenses filtering through, maybe due to broader monetary policy shifts.
Okay. A sequential rebound sounds positive, but let's be a bit skeptical here, as the market often is. If Q4 just bounces back from a weak Q3, is that truly a sign of recovery? Or is it just proof that Q3 was particularly bad, maybe due to the weather and things haven't hit rock bottom yet? What's the major caveat here?
You hit the nail on the head there. The major caveat, the big but, is the year-over-year comparison.
Comparing Q4 this year to Q4 last year?
Exactly. Despite that expected quarter-over-quarter seasonal rebound, many sources are warning that Q4 profit is still likely to contract when compared to Q4 of 285.67.
So, still weaker than the same period last year.
That's the expectation. Fundamentally, overall sales are still likely to be weaker than they were a year ago. And to try and stimulate those sales in a tough environment, the company has to keep spending on marketing. They need continued, probably aggressive marketing activities, like their big promotional events.
And more aggressive marketing usually means more pressure on those already slightly squeezed margins, right?
Precisely. It costs money to drive sales when consumers are hesitant.
Can you give us examples of those specific Q4 sales drivers they're relying on? What kind of events are we talking about?
Well, they're leaning heavily into these big promotional expos designed to attract high-value purchases. For example, they hosted a major HMPRO electric expo back in October 2568.
Okay. What happens at an expo like that?
They bring in all the top global appliance brands, showcase the latest product innovations, smart AI washing machines, fancy new mini LED TVs, that kind of thing. The goal is clearly to boost sales by tempting customers with new tech and compelling promotional deals or packages.
Trying to counteract weak spending power with shiny new things and discounts.
Pretty much. And these events are oftentimes strategically, too, maybe hoping to capitalize on potential government stimulus measures, like the Easy E-Receipt scheme, to give people an extra nudge to spend. Now, for investors thinking longer term, this short-term profit struggle needs to be weighed against some of the concrete actions the company has taken to deliver shareholder value. The most notable recent action was probably the share buyback program.
Right. Walk us through the conclusion of that program. It finished up in Q3, didn't it? And I remember reading it was actually quite a bit smaller than what they initially authorized.
It did finish, yeah. The buyback program, which was primarily aimed at managing their capital structure and maybe supporting the share price, officially ended on September 30th, 2568. Over the course of the program, HMPRO bought back a total of 180.19 million of its own shares.
Okay, 180 million shares. What percentage of the company is that, and what did it cost?
That represents about 1.37% of their total paid-up capital. The total cost for buying back those shares was 1.36 billion Thai baht.
Now, what's significant, as you mentioned, is that they used way less than the maximum amount they were authorized to spend. I think the original authorization was for up to 800 million shares or a budget of 7 billion baht.
That's correct. They spent much less.
So what does that signal to an informed investor? Why didn't they buy back more shares if they had the authorization?
It really signals two things, I think: fiscal prudence and high price sensitivity. They basically refused to chase the stock price higher just for the sake of buying back shares. It suggests management had a specific valuation window or price range in mind, where they thought the buyback offered good value. Once the stock price perhaps recovered slightly above that level, they stopped buying, choosing instead to conserve the remaining capital.
Which is probably wise in a weak macro environment, right? Preserve cash.
Absolutely. It shows they prioritize maintaining their strong cash reserves and that incredibly low debt ratio over simply maximizing the share count reduction at any price. Discipline again.
So for investors holding the stock, what's the potential future upside from those shares they did buy back? What happens to them now?
Well, the primary upside comes from the potential future cancellation of these treasury shares.
Okay.
If HMPRO doesn't sell these shares back into the market within a designated time frame, usually around 3 years, they are typically required to cancel them. This reduces the total number of outstanding shares permanently.
And less shares means?
Less shares means your slice of the profit pie gets bigger. It mathematically boosts earnings per share, or EPS. That's generally very favorable for shareholders and seen as a sign of management's commitment to creating value internally.
Okay, so the buyback offers potential future EPS growth. Now, beyond buybacks, HMPRO has long been seen as a pretty solid dividend stock, hasn't it? Does that appeal still hold up even with the current earnings pressure?
It absolutely does. And frankly, this is probably the key factor anchoring more defensive investors to the stock right now. Despite the profit contraction, HMPRO is maintaining its reputation for stable, reliable dividend payouts.
Do we have numbers on the expected yield?
Yeah, analyst estimates for the expected dividend yield for the period 2568 through 2569 are actually quite attractive. They're generally cited as falling somewhere in the range of 4.9% to 5.0%.
Almost 5%. In this environment, that's pretty decent, isn't it?
It really is.
Yeah.
In a low-growth world, getting a reliable yield close to 5%, backed by a company with strong cash flow and a solid balance sheet, well, that offers a crucial component of total return for investors, and they backed this up recently, paying out an interim dividend of 0.16 baht per share back in September.
Okay, dividend appeal remains strong. Finally, let's just quickly touch on where the stock is actually trading right now and what the technical analysts are saying about key price levels.
Sure. As of around mid-October 2568, the stock price was hovering around the 7.1 Thai baht level.
Yeah.
Technical analysis, looking at the charts, identifies some specific zones to watch.
Support and resistance.
Exactly. The crucial support levels, think of these as potential price floors, where buying interest might step in, are cited around 7.25 and 7.35 baht. Holding above these levels would be seen as positive, technically.
And on the upside, where might it struggle? Conversely, the resistance levels, areas where selling pressure might emerge and cap the price, are noted up around 7.80 and 8.000 baht. Breaking decisively through that 8.000 bat resistance level would likely require some significantly better news, probably a positive shift in those SSSG expectations we keep talking about.
Okay, let's try and synthesize the complexity of everything we've just discussed in this deep dive.
Yeah.
On one hand, you have HMPRO with these really robust foundational metrics, that incredibly low 0.7x debt ratio, strong cash flow.
Yeah.
And management is clearly executing highly proactive long-term strategies.
Yeah.
You've got the hybrid stores, the massive omni-channel ASRS investment, those targeted store renovations. They are definitely fighting the good fight and with immense operational skill by all accounts.
Agreed. They absolutely have the resilience baked into the balance sheet, and they have a clear strategy for the future. However, and it's a big however,
the Q3 data confirms that persistent, almost unavoidable issue. SSSG remains negative. And the expectation is it's likely going to continue that way through Q4 simply because of the macro environment. That external weakness is effectively suffocating their ability to generate significant top-line growth right now.
which brings us right back to the core question that you, the listener, are probably asking yourself. Given this intense pressure to manage costs and the very real limits on consumer spending power, is HMPRO still an attractive retail growth stock?
Yeah, that's the million-dollar question, isn't it? And I'd say in the current climate, HMPRO is behaving less like a traditional high-growth stock.
Yeah.
You know, the kind that delivers explosive sales expansion year after year.
Okay, so what is it behaving like then?
More like a high-quality, highly resilient company that's focused fiercely on maintaining its margins, improving efficiency through technology like ASRS, and probably consolidating its market share while weaker competitors struggle during this downturn.
So more defensive than aggressive growth.
Yeah, exactly. And that attractive 4.9% to 5.0% dividend yield we talked about, that stability really underpins its current appeal as more of a defensive quality holding.
So the growth story that maybe excited investors in past years, where does that come from now?
Well, that narrative now relies heavily on two critical things happening. First, the long-term success, and crucially, the rapid ramp-up of these new hybrid store models, proving they can successfully capture that B2B sector revenue stream. And second, simply the eventual fundamental recovery of overall consumer confidence and spending power in the Thai economy.
So they're perfectly positioned for growth, but they need the market tide to turn for them to actually realize it.
I think that sums it up well. They've built a very sturdy ship, but they need the wind to pick up.
That distinction between a quality or resilience play and a pure growth stock is absolutely essential for investors trying to position themselves right now. But hey, before we wrap up, let's pivot just slightly to something HMPRO is doing that's maybe outside the immediate sales numbers but speaks to their long-term thinking. Sustainability and the circular economy.
Yeah, that's a really powerful long-term theme, and it often gets overlooked when everyone's hyper-focused on the quarterly earnings cycle. The sources we looked at do know HMPRO's commitment to sustainability initiatives, specifically projects around the circular economy.
What are they actually doing there?
Well, they're actively collecting waste materials from customers, things like old plastics, broken tiles, scrap metal. And instead of it just going to landfill, they're processing these materials into something called PCR pellets, post-consumer recycled pellets.
Okay, and what do they do with those pellets?
They use them to create new circular products that go back into their own supply chain, potentially reducing their reliance on virgin raw materials.
Now that moves beyond just, corporate social responsibility or greenwashing. That sounds like it could be a strategic move with real financial implications down the line.
It could be.
So, perhaps the provocative thought we leave you, the listener, with is this. How much value, both financial, maybe by cutting raw material costs through internal recycling, and environmental, of course, how much value will this long-term commitment to the circular economy eventually unlock for HMPRO, completely separate from their immediate quarterly retail sales performance? Could that ability to internalize waste streams become a hidden source of margin resilience or competitive advantage years down the line? Something to think about.
Definitely food for thought.
That was our in-depth look at HMPRO, analyzing their robust strategic response to what was clearly a very challenging Q3 2568. We really hope this comprehensive analysis of their efficiency, their expansion plans, shareholder metrics, and that future sustainability angle helps you in your own decision-making process. We appreciate you diving deep with us today.